What a day it turned out to be yesterday. Start of a truncated week and wasn't really the best one. Yes, sure enough, we did pull back from those 19,500 sub levels. But the kind of weakness that you're seeing with key heavyweights, cases in point being Reliance, HDFC Bank, and the consistent weakness, so to speak, that's really weighing heavy on the indexes. In fact, to add to the bag, there was also ICICI Bank and ITC as well, which did really drag. There has been overnight a sharp rise in global yields as well that you've been seeing. And once again, it was the broader markets which outperformed what the benchmark did. And it's been too consistent, this weakness in Reliance and HDFC Bank. And unfortunate as it may be, given their weightage, the Nifty can only do that much.
Sasha, it's a macro adjustment.
Yeah.
I don't want to use the word sell-off. Sell-off means that things are really falling off the cliff. It's not like a global sell-off. This is a macro adjustment given where the bond yields are moving higher. Now, before we talk about last 3 days, you have to talk about last 3 months to put things into context. And if you analyze the last 3 months, then last 3 days or last 5 days would appear more like a routine profit booking, which has originated because of rising bond yields. Why are bond yields rising? Well, when bond yields they rise, equity as an asset class will always see adjustment. Flows will move out of emerging markets, and that will have an impact on the dollar index. So the setting on the table is something which is not very difficult to understand. What may happen, and what I think is clearly evident now based on the market action, is that now you've got a roof in place. And when benchmark indices, whether it is closer to 20,000 or just above 20,000, looks like this time we have a roof in place and the downside of the market is open. So now the market will gradually shift and rediscover the lower end of the range, which may take some time. So in the near term, when I say near term, in the immediate next couple of days, the path of least resistance for the market is on the lower side. It is largely because of what is happening in the global markets, and FI selling, which is a combination of global macro as well as local profit as well as profit booking, I think is having an impact on the way how some of the heavyweights are moving. Now, it is a function of global adjustment which is making HDFC Bank and Reliance go down or vice versa. You can't judge that, but we are going through a global adjustment where in the short term the upside of the market is defined and the downside is something which markets will discover in few days.
Yeah, talking about downside, from the recent highs, the Nifty Bank has fallen about 4%, which is 1,800 points. Now, if you were to really traditionally stack it up with how much we've fallen in the previous bull market corrections, we've not fallen too much. The Nifty is less than 3.5% away from its recent highs, and the mid and the small caps are like 1.5% apiece.
Aisha, 3-4% in the best of the bull market is more like a routine correction.
Exactly.
And I think that this market correction also in hindsight, when we will analyze it, it will be very sharp, it will be very swift, and it will be forgotten. Nobody is talking about what happened to the market same time last year. So profit booking is part, or correction is part of any bull market, and it will always create fresh entry points. So how is this leg of decline different? Well, this leg of decline is different largely because global cues are also dragging it down, and the good differentiating factor for us is that the appetite into Indian equities, I think, is insatiable, whether it is from the HNI crowd or the retail crowd or perhaps from some of the family offices. So I will not be surprised at all that individual stocks, they will continue to do their good work. Earnings season, it has dawned on us, and you may be in for some adjustment here and there, but barring that, I think the whole India appeal is so strong that the downside is going to be shallow. I come back to that point again, that corrections are par for course for any bull market and they make the market healthy. But in this leg of decline, the three things will happen. I'm firmly of the view that India will outperform. I'm firmly of the view that HNI and retail appetite will safeguard Nifty and Sensex stocks from the mid and the small cap stocks from a free fall, and see the whole positioning in terms of where things are changing, I think will make India stand out.
Okay, that's the overall setup for the markets, but let's also take cognizance of what's happening across the globe because that really merits attention. It's been a losing session on Wall Street. You had the job opening data, and that has indicated that the labor market is strong, but bond yields continue to inch higher. So we did have the Dow Jones, which notched its worst session since the month of March. You had the S&P 500, which one point hit its lowest level since the month of June, and you had the Nasdaq wrapping up close to 2% lower. So that has pulled most of the indices into the red for the year. The 10-year Treasury yield, that is as well what we're monitoring, as well as the 30-year Treasury yields, both at their highest level since 2007. And the average rate on the 30-year mortgage as well has approached about 8%. The jobs data as well has bolstered a case for now higher case. And yes, for the Dow Jones, Nikunj, we've turned negative for the year 2023. So how disconcerting or how much attention should we pay to the rising bond yields and what we're seeing play out across Wall Street?
See, bond yields are at levels where they'll start pinching you. And if they go higher, they'll start hurting you. From an environment where they were favorable, now the pinch has started and then the hurt will start. To put things into context for our viewers here, rising bond yields means that the cost of capital in the world is going higher. If the cost of capital in the world is going higher, it will have an impact on the underlying valuation of equities. Also, if you are a investor, now you have an option to say, okay, I can park capital in US bonds where I'm getting a safe 5% return versus do I deploy it in emerging market equities, especially markets like India, where I'm taking a risk because of the underlying volatility and the nature of the world. So the temptation to lock some gains or lock some investments at 5% bond yield with a perspective that interest rates will not stay up for long, I think is a very reasonable temptation, and that surely will have impact on the flows, and I think that is visible in the way how money is moving out. Now this is not like a COVID setup where the interest rates were abysmally low. So in the hunt for yield forced everybody to come to emerging markets. I think at 5% or closer to 5%, the yields in US are strong enough, and that in a sense could be the biggest near-term challenge for flows to come back into India. We're exceptionally lucky with flows into India this year, but of late the flows are reversing, and that is a function of profit booking and rising bond yields. So you cannot undermine the rise in bond yields. Anything above 5% is something which will start hurting flows and also the global risk appetite.
Interesting note though from Morgan Stanley this morning, talking about the India strategy, stating clearly that India is definitely one of their top picks within emerging markets, but also talking about how the calendar is packed with events with a binary outcome.
So, Aisha, to be fair, Morgan Stanley and Rhythm and his team, they've just been vocal about why they've liked India, and whatever they had in a sense projected and whatever they had indicated in terms of the macro trends and in terms of the shape of the economy, I think that has really aligned with what their broader thought was. Now, of course, volatility is coming back, and the reason why volatility is coming back because valuations, the global setup, the underlying current of local events like election cycles, that really is at play, and that will lead to volatility. But Morgan Stanley is also of the view that while the trade is going to be volatile, the direction is not going to be south, the direction is going to be north. And volatility is a function of events, valuations and flows. And for next couple of quarters or next couple of months, there are a lot of events, earnings season, election cycle, state election cycle, and then the valuations exactly are not at a throwaway price, and then you've got this whole interchange of what is happening in the macro market. So I think volatility is something which you need to be prepared for. There's a difference between risk and volatility. I firmly believe that there is little risk, but there is going to be high volatility.
Okay, volatility is the name of the game. Perhaps that's the take coming in from Nikunj. But let's move right on then.